Tanker tumult. Tanker rates whipsawed, the impact on fleets, refiner margins, and U.S. oil prices. Doom and gloom from metal companies, looking for signs of a slowing global economy from U.S. aluminum, copper, and steel producers. Colombia lets the sun shine in. I sit down with the Energy Minister of Colombia, a country with ambitious climate goals, about how it's wooing foreign investment. I'm Alix and welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On. It's our take on the big story. Our spotlight today is on rising tanker rates. All around the world, prices to move oil have surged. President Trump sanctioned 2 units of a Chinese shipping company, plus an Iranian tanker was attacked in the Red Sea. Earlier, I spoke with Tony Gurney, CEO of Ardmore Shipping.
The spark that really drove the upturn in the big ships has been the sanctioning of the COSCO fleet. In reality, you had a accumulation of events which took out probably 10% of the VLCC fleet. The spike we just saw in rates is really an inflection point. I think it's a sea change for the way the oil industry is going to view, and we're seeing it. The sentiment has really shifted.
Joining me now is Eric Broekhuizen, head of tanker research and consulting at Potent & Partners, which is the largest U.S.-based ship broker. You have literally the inside track in this. Will we see continued higher shipping rates? Can we sustain high levels that we've seen?
I think it's good to put the rates a little bit in perspective. Rates were actually quite low for many years. 2016 through the first 3 quarters of this year. Average VLCC, the large tanker rates were probably around $25,000 a day on average. So now you've seen a spike to over $300,000 a day, which was in a way unsustainable. It could not be sustained. And over the weekend, rates have started to decline.
So what's normal?
What's normal?
It should be normal.
It should be normal. It's a mid-cycle rates, what gives a decent return to the owners and doesn't impinge on demand, would probably be in the $50,000 a day range. 40 to 50,000 would give the owners a good return, and it will not hinder the refiners to buy the crude that they need. Well,
I'm glad you brought up the refiners, because there's been lots of little ancillary issues when it comes to the high tanker rates. One of them are in particular Asian refiners, their margins really rolling over because they have to pay a lot of money to transport that crude. There's 2 narratives. One is they're going to keep on buying. The other, demand's amazing. And the other is that they're going to stop buying because it's too expensive to move the oil. Which one's true?
I think refiners in general, they can adapt to higher transportation costs. I think what was in particular this case, it arose so quickly that I think then the refiners decided that some of the less sophisticated ones that have lower margins, they decided to tap the brakes and say, okay, let's hold on, let's see how this settles down. Because when you have to pay $12, $13 per barrel transportation on a $50 to $60 commodity, then it becomes quite expensive. So now those rates have come down quite significantly. They're still much higher than where they were a month ago, but they're like at the $100,000 a day level now.
So if they stay there, which is still higher than I think fair value you were talking about, what does that do to regional oil prices? And I just want to focus particularly on WTI and Brent, for example. There is one narrative in the market that you're going to see lower oil prices here in the U.S. because no one's going to want to buy our oil because you got to ship it so far, and the tanker rates are too high. Therefore, oil prices have to correct. Is that the correct narrative from where you see it?
That would be a first in a way that tanker rates would drive oil prices. Yeah. So I don't really see that happening over the longer term. It could if this $300,000 a day market were there to stay, but it's already finished. It's already over. It's way down. So I think I don't see U.S. oil exports or destinations influenced in the longer term by tanker rates.
Are you telling your clients that this sort of volatility and or re-rating for modestly higher rates is something that they have to start prepping for?
Yes. The rates will be at a higher floor for the foreseeable future.
And what do they do? How do they deal with that, especially if there's volatility involved?
I think the way to deal with it is you can take some hedging positions, so you can charter in some ships for longer periods of time. So even though the rates for spot market voyages went to $300,000 a day, the time charter rates where you can rent the ship for a year, they only moved up to $50,000 or $60,000 a day. So I think oil companies, if they're afraid about the volatility and very high spikes, they probably can hedge a little bit of their needs by taking ships on period charter rather than take everything on the spot market.
Eric, I really appreciate it. Thank you very much for your time today. Eric Broekhuizen of Potent and Partners. And as we head to break here, Volvo unveiling the automaker's first all-electric vehicle. We spoke with Volvo's CEO.
From day one it will be profitable, but of course in the very low volumes you have to understand that the cost level will be higher, so it might be a lower profit margin initially, but I think what counts is a bit more mid-term, and then we definitely believe that an EV car will have a higher value for the consumer, and long-term it's absolutely the right thing to do.
I'm Alix Steele, and this is Bloomberg Commodities Edge. It's time now for the Data Dig, where we delve deep into the market trends of the week. So first up, those oil inventory numbers showed a larger than expected build, but the interesting part, it was in every single pad. A big part of that is refinery maintenance, and the other one we're looking at is potentially that export arb closing as tanker rates stay elevated. Something else we're looking at here has to do with hogs in China. So the number of them plunged by more than 40% in September. Some say it could be even more. That's from a year earlier, as the impact of the African swine flu really became a lot worse. That is the biggest drop the country first reported an outbreak of the deadly virus last year. It's the biggest drop so far. And it's not just hogs we're looking at in China, it's also steel prices potentially flashing a warning sign. The spot rolled hot rolled sheet benchmark product used to make vehicles and appliances now is at the lowest level since November. That then hurts mills' profitability. So we want to stay with some of the industrial metals here. We got earnings from Alcoa, and that all added to the slowing global economic growth story. So here with a breakdown for me is metal and mining analyst Joe Doe. Walk me through Alcoa, sort of what was idiosyncratic and what is a really tough aluminum environment.
They were pretty straightforward. They are downgrading their 2019 outlook to as low as negative growth, so negative 0.6%. We haven't seen something like that in a long time. And really the focus that they kind of geared things toward in this earnings report was that they're going to try to do an asset, look at their asset portfolio and gain about $500 million to $1 billion in sales from that and use that cash for other things. But the real point here that analysts were talking about this morning was, yeah, that's great and fine, but near-term things look really tough. And everybody in the aluminum industry, from analysts to companies to traders, have told us now for months that this is not a space that looks fantastic. And I think Alcoa finally just confirmed that yesterday.
So do we get the sense it's a demand or supply problem?
Well, I think it's a little bit of both. Sure, China continues to produce a lot more, and that has been the story for ages. But really, we are seeing a slowing in manufacturing. We've seen the steelmakers say, yes, the manufacturers are slowing, and Alcoa says this. And that really is a demand side thing, right? So suddenly, if you're combining demand and already increased supply, that's why you see people, they're really not touching this space at the moment.
The other interesting thing is what we've seen in iron ore. Like, not that long ago, it was $100 a ton prices is what we were talking about, and now that's been totally shifted. What happened there?
I think a big part of it is Vale finally getting back online, right? So about half of what they had taken offline because of the tailings dam is finally coming back. They've ramped up in other areas within Brazil, so that coming onto the market, in addition to Rio and BHP saying that they're continued to produce. I think BHP said they expect a 6% increase through June 30th of next year, which is kind of the end of their year. So everywhere we're just seeing supply coming back online in a space that had been worried for all of 2019 that maybe there would be a supply problem.
All right, Joe, really appreciate it. Thank you so much, Joe Doe from Bloomberg. All right, now we want to get into the ring. It's U.S. E&Ps versus investors. Parsley Energy plummeted the most in 20 months as it bought a rival driller, Jagged Peak Energy, for $1.6 billion. That's an 11% premium. Parsley now has 267,000 net acres and sees as much as $50 million in annual operational and SG&A synergies. Joining me now for her take is Betty Jiang, who covered E&Ps for Credit Suisse. Good to see you.
Thank you.
So part of the reason why investors got so mad is because they thought that Parsley would be a take-out target. Can it still be bought?
I think it absolutely can still be bought. The deal makes it even more compelling takeout candidate because they're still a pure play Permian E&P, but they're bigger, stronger, and generate more free cash flow. With the deal, they're actually the 5th largest Permian company by position size. Outside of the majors, or the 7th largest if you include the majors. So that critical mass is really important, as we believe the next wave of consolidation is being done by the big integrateds.
So why did investors react so poorly to this?
I think a big surprise is a big factor, as you said. People thought Parsley was a seller rather than a buyer. That
they were going to sell themselves rather than buy something else?
Yeah, exactly. And that surprise factor came in, and then there are other concerns about integration, execution, operated synergies, and then the macro 2020 outlook. But I think a lot of these concerns are overdone, and the surprise factor is really the biggest driver for the negative reaction on day one.
So in terms of your work, in terms of, say, synergies, can they meet the targets? What do you see? And talk about the position of now what Parsley has and what they've added to the portfolio.
Sure. I think it's really important to see this deal as an acquisition of a business that generates a lot of cash flow rather than an asset package. They are slowing down activity and they're cutting costs. So the Jagged Peak today and the Parsley is generating free cash flow versus on a standalone basis, they were actually outspending. So that allows them to generate more free cash flow and sort of answering what the investor was asking for about free cash flow generation and returning cash to shareholders.
So do you think that we're going to see more of these deals, or are we finally going to get more of the majors coming in and buying sort of the mid-sized companies that we've been waiting for?
No, I think the bigger wave of consolidation will be coming from the integrated, but we don't really sense an urgency from their side to coming to the space now. So more likely in the near term, we're going to see merger of equals like transactions more similar to the Parsley and Jagged Peak deal.
How hard is it right now to be a U.S. E&P?
It's very difficult, I think.
Is it worse than 2016?
It is worse just because the capital market is not really open to these companies. They can no longer outspend cash flow, and then the investors' call for more free cash flow generation is really tough for the shale business that has very high declines. So today, generating free cash flow and living within the mean is really important for the U.S. E&Ps.
Who's doing it right?
I think some of the larger companies, the larger cap E&Ps are really committed to free cash flow generation. A Diamondback within the Permian is can grow double-digit production growth and still generate free cash flow. So scale really matters right now.
All right, Betty, thank you very much. I really appreciate it. Betty Jiang of Credit Suisse. And it's time now for our note of the week, and it comes to us from the head of the ESG office at Berenberg. They're snubbing the $16 trillion U.S. Treasury market. Rupini Deepa Rajagopalan says, quote, ESG-dedicated investors would usually avoid or question investments in U.S. Treasury. She goes on to cite the death penalty, nuclear weapons, and the U.S.'s non-participation in global environmental accords like the Kyoto Protocol. All right, coming up, Colombia Energy Minister will be joining us, Maria Fernandez Suarez, on the country's solar and wind ambitions. Next on Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. It's time now for the BNF Brief, which gives an in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. And this week, we focus on China's aggressive move into Latin America. This chart shows the top 5 wind and solar assets, and China owns 2 of the 5 largest. Joining me now is James Ellis from Bloomberg NEF in Sao Paulo. James, why? Why does China want to get so heavily invested in alternative energy in Latin America?
Sure, Alex, thanks, and great to be here. It's a very interesting question. As you said, 2 of the 5 largest clean energy project owners in the region are now China-based, and the other 3 are based in Europe. So we can definitely say that purchases of wind and solar assets are reshaping, by Chinese companies, are reshaping Latin America's renewables landscape. It's a very interesting change from a few years ago when, had we looked at this list of the top 5, it would have absolutely been dominated by European utilities and local players as well. Historically, China's role in renewable energy in the region has really been as a supplier of PV modules, which increasingly cheap solar equipment is one of the key driving forces behind renewable energy's rise. So this is a very interesting change and really a transition from Chinese companies being primarily suppliers of PV modules and branching into a role of being more of key investors in Latin America's utilities and more broadly infrastructure.
Can you give me some perspective of like how much money has gone into Latin America from Chinese companies in this industry?
Absolutely. We've seen a couple of very interesting deals recently with Sempra's divestiture of its South American operations. 2 deals in particular I think are worth highlighting. That's the sale of their assets in Chile for about $2.2 billion, and then also the divestiture of their assets in Peru. These are very significant investments that total about almost $6 billion. And when you look going back to 2014, total Chinese investment in the power market in Latin America has been about $36 billion. So it's very significant, and it's providing really a lot of liquidity to the market as investors like Sempra pull back.
All right, James, thanks a lot. I really appreciate it. James Ellis joining us from Bloomberg NEF. We want to turn now to Commodity in Chief, where we focus on one executive in the commodity world. And today, it's the Colombian Energy Minister, Maria Fernandez Suarez. First, a closer look at Colombia's energy sector. Colombia has big energy needs and big plans. Here's the problem. The oil industry is finding it harder and harder to replace reserves. In 1998, the country had 2.5 billion barrels, and now it's just 1.8 billion. One hope is to use fracking, which could increase the country's oil reserve life to 15 to 20 years from around 6 right now. But commercial development is currently tabled with the exception of some pilot projects. The other big part of its future is green. The country has ambitious plans for a 30-fold increase in the amount of solar and wind energy it generates over the next 3 years. And to get there, it will auction 15-year contracts for renewable power, and it needs the private sector to install 1,500 megawatts of solar and wind from 50 now. All of Latin America is opting for an aggressive clean energy push. Colombia, though, has the advantage, especially over Argentina, stuck in an unstable political situation and upcoming election cycle, and over Venezuela, suffering from an economic collapse. Colombia wants as much as 10% of its energy from those renewable sources by 2022, and now it's got to deliver. I recently caught up with the minister, and I asked her about her plans for renewable energy.
One of the most important things of my agenda is regarding renewable energy and how are we going to make sure that we accelerate the introduction of variable renewable like solar, wind, biomass, and other forms of energy. So Colombia has a matrix that is pretty clean. Our mix, we have 70% of hydro in our power mix, that we need to accelerate the introduction of solar and wind. So we will be holding an auction in October. And we will pass from 50 megawatts, that's around 0.1% of the total installed capacity, to 10% of our power mix of variable renewables by 2022. So what we announce is that 70% of the energy, of the power mix, will come from renewable energy by 2030. That is the most ambitious goal set by renewable energy in all around the world. For you to have an idea, European Union has set a target of around 30 to 35% by 2030. And the rest of the countries or regions that have set a target are between 25 and 40%. So Latin America sets a very important target, setting up 70% of renewable energy by 2030 in the power mix.
What do you have to do to get there?
We have set up the right fiscal fiscal incentives, so you do not have any BAT, you do not have any trade tariffs, zero trade tariffs, and you also have the possibility of deducting on your corporate tax rate 50% above the 100% that you always deduct with depreciation of all the investments made in renewable energy. So all that framework gives you the possibilities of accelerating that energy transition.
What kind of fiscal abilities does Colombia have to do that? For example, like Argentina couldn't really do that. Venezuela couldn't really do that. Like what do you have that other people don't?
Well, really, Colombia has a very stable macroeconomic scenario, and we have been very prudent in terms of fiscal usage. Actually, we're going to have this year a surplus, so that's something that is very positive. And what we have said is that in the tax reform that we passed through Congress in 2018, we put a lot of incentives in terms of new investment.
What kind of foreign money have you seen over the last year, and what are your targets, say, for the next 5 years?
So we have seen a very successful policy coming in, and in this semester we see that foreign policy grew 24%, and our target is for that continue to grow. I think that part of what the country is doing is that we want to diversify our economy. So definitely on oil and gas industry, and also in mining, and also in energy, we're seeing a lot of companies coming in. We see, for example, new investment coming from AES, that is a US company. We see Canadian companies coming to buy some thermal plants. 2 thermal plants have been bought in this semester. But also we want in other industries to come. So there is a big bet on tourism, a big bet in agriculture, and very important in all that has to do with technology.
That was my interview with Maria Fernanda Suarez, Colombia's energy minister. And check this out. Keeping the flies away has never been so black and white. Scientists in Japan have discovered a new way to reduce the need for using pesticides on cows. So pick up your pallets here, because it turns out that painting zebra stripes on cattle significantly reduces attacks by biting flies. The results are really stark. Researchers found out that zebra-painted bovines were bitten nearly 50% less than solid black animals. And what's a little fly bite, you ask? Well, it's more than just an annoyance. The insects interfere with cattle grazing, feeding, and increase fly-repelling behaviors like foot stamping and head throwing, which increases heat stress and the risk of injury. Nothing to shoo at. Fly bites are estimated to cost the livestock industry billions every year. And here's what's on my commodity radar for next week. Monday, you get earnings from Halliburton. Don't miss that. And Wednesday, lots of earnings. Some highlights, though: Tesla, Caterpillar, as well as Freeport-McMoran, copper, and gold. And Thursday, you get numbers from Vale. More insight into those iron ore prices. Well, that does it for Bloomberg Commodities Edge. Make sure to catch us each Thursday at 1 p.m. This is Bloomberg.